I have spent most of my life watching people misunderstand money. Not because they are stupid, not because they are lazy, and not because they lack the ability to learn. They misunderstand money because fear is louder than arithmetic. Rumor moves faster than truth. And in a nervous age, people would rather grab a dramatic explanation than sit quietly with an ordinary one. That has always been true in markets. It is true in bull markets, when people think every stock is a ticket to easy wealth. And it is true in anxious periods when people become convinced the whole system is one headline away from collapse. What changes is the costume. One decade, the costume is .com stocks. Another decade, it is housing. Another decade, it is inflation. Another, it is banking panic. Then it becomes central bank conspiracy, cash withdrawal rumors, gold confiscation fears, silver shortage talk, or some new phrase that spreads online so fast people repeat it before they stop to ask a very simple question. What exactly is true here? I have learned that if you can stay calm long enough to ask that question, you already have an advantage over most people. The world keeps trying to sell investors emotional urgency. It tells them they must react now. Buy now, sell now, hoard now, withdraw now, hide now, because some rule is changing, some agency is coming, some threshold is falling, some institution is secretly preparing to trap them, some paper market is about to vaporize, some historic reset is about to reward only the people who moved first. That kind of story is powerful because it makes the listener feel like an insider. It flatters you. It tells you the masses are asleep, but you are awake. It tells you safety belongs to the people who can see the hidden pattern. It replaces the hard work of thinking with the thrill of decoding. And when people are financially insecure, decoding becomes addictive. I understand the appeal. If you are worried about inflation, taxes, banks, retirement, debt, or the value of the dollar, then a dramatic explanation feels more satisfying than a boring one. It feels active, it feels protective, it feels intelligent, but in finance, the feeling of control and actual control are often two different things. That gap ruins people. I have seen families spend years building savings only to make one large decision based on panic. I have seen sensible people become obsessed with signals that do not matter while ignoring the few decisions that matter enormously. I have seen them focus on whether the government will lower some reporting threshold or whether a mint suspension means the paper market has permanently broken, while they neglect the obvious leak in the boat, which is overspending, poor asset allocation, unnecessary debt, weak cash management, and the habit of acting on rumor before evidence. The irony is that financial fear often pushes people toward the very behavior that makes them more fragile. They move too much cash without a plan. They buy assets they do not understand. They hold things for emotional reasons instead of economic ones. They trade a durable strategy for a dramatic gesture. They become more concentrated, more illiquid, more suspicious, and less rational, all while telling themselves they are becoming safer. If I were talking to a family across the kitchen table, I would begin in a very old-fashioned way. I would say that before you decide what to do with your money, you need to separate three things. First, what is legally true? Second, what is economically true? Third, what is emotionally loud? Those three things overlap less than people think. A rumor can be emotionally loud and legally false. A legal change can be real and economically small. An economic danger can be massive and still attract little attention because it is dull and familiar. Most investors lose money in the third category. They respond to what is loud. The wealthy, at least the durable kind of wealthy, spend their lives learning how not to do that. I want to walk through a cluster of claims and fears that have been making the rounds, not because each one deserves equal weight, but because together they reveal a much bigger lesson. The lesson is not really about cash withdrawal thresholds, gold rules, silver supply, or the Federal Reserve System. The real lesson is about how to think when money and fear start talking to each other. That is where fortunes are preserved or destroyed. Take the fear around cash withdrawals. When people hear that a reporting threshold might change or that large cash movements attract scrutiny, Many of them leap instantly from reporting to prohibition. They hear paper trail and think confiscation. They hear scrutiny and think criminalization. They hear threshold and think trap. Now, a rational person should always understand the rules governing money movement. Of course you should know that banks report certain cash transactions. Of course you should know that governments like information. Of course you should assume that large movements of money inside the financial system leave a record. None of that is surprising. The modern financial system is built on records. But the existence of a record is not the same thing as the loss of a right. That distinction matters. Too many people hear that a transaction is reportable and immediately behave as though it has become forbidden. Then they begin structuring their financial life around a fear that has not been proven. They withdraw or deposit in awkward ways. They split actions into strange patterns. They create friction for themselves. They act guilty while doing nothing illegal. Then they wonder why the whole process feels hostile. I have found that the market and the financial system punish people who cannot distinguish inconvenience from catastrophe. You do not build a life around every possible change in reporting. You build a life around clarity, legality, and intentionality. If you need cash for a lawful purpose, then you should have a lawful explanation, a clean record, and a sensible reason. What gets people into trouble is not reality. It is improvisation under stress. That is true in markets too. A person who buys stocks with a plan can survive volatility. A person who buys them because everyone else is excited usually cannot. A person who holds cash for a clear need can defend that choice. A person who moves cash in a fog of suspicion becomes trapped inside his own behavior. I have no interest in telling people to be naive about institutions. Institutions pursue their interests. Regulators expand their reach. Bureaucracies rarely shrink themselves voluntarily. You should know that. But there is a large difference between healthy skepticism and theatrical panic. Healthy skepticism asks, what is the rule? Where is the text? What is enacted? What is proposed? What is enforced? What is merely discussed? Theatrical panic asks, what is the scariest interpretation I can attach to this before lunch? One of those habits protects wealth. The other destroys judgment. The same pattern shows up in the recurring fascination with gold and silver. I understand why precious metals attract attention, especially in uncertain times. Gold has a long history as a store of value. It is scarce, durable, recognizable, and psychologically powerful. When people lose trust in paper claims, they move mentally toward what feels real. A coin in the hand has a kind of emotional certainty a brokerage statement does not. That feeling is not irrational. It just needs to be kept in proportion. When a rumor begins circulating that some global banking rule has fundamentally changed the treatment of gold or silver, people often skip straight to the ending they want. They want a single regulatory event to validate their worldview. They want one switch to flip and prove that paper was fake, physical is supreme, and all the years of suspicion were justified. That longing for vindication is expensive. I have spent decades learning that investors often do not want truth as much as they want confirmation. The worst financial decisions are usually made when a person starts treating an asset not as an investment, not as a reserve, and not as a hedge, but as a personal identity. Once that happens, evidence becomes optional. If you own some gold as insurance against currency weakness, systemic stress, or political foolishness, I can understand the logic even if my own preference has always been for productive assets. But once you begin needing every banking rule, every mint announcement, every policy rumor, every market dislocation to prove that your worldview is right, you are no longer thinking like an investor. You are thinking like a believer waiting for a sign. Belief is a dangerous substitute for analysis. The world is full of people who can explain to you, in extraordinary detail, why some coming repricing of gold or silver will reorder the entire financial system. Many of them cannot explain their household budget, their debt load, their savings rate, the tax efficiency of their accounts, or the return they are earning on their actual capital. They know every rumor. They do not know their own numbers. That is backward. Your own balance sheet should interest you more than any grand theory. The obsession with whether banks can or cannot use this collateral or that collateral, whether some international framework has changed the hidden plumbing of the gold market, or whether rehypothecation is about to be curtailed forever, often becomes a substitute for the far more useful question, which is this: what role should any non-productive asset play in my life? That is the adult question. For me, the answer has always been limited. Gold does not produce earnings. It does not innovate. It does not hire people. It does not distribute dividends. It does not create value through enterprise. It sits there. That makes it useful for certain psychological and defensive purposes, but not magical. I would much rather own a wonderful business over time than a shiny object. I hope another frightened person will value more next year. But I also understand the world well enough to know why fear drives people to hard assets. If a person has lived through inflation, capital controls, banking disorder, or currency instability, then owning something outside the promised structure of institutions can feel prudent. The mistake comes when prudence becomes absolutism. Nothing should be worshipped in a portfolio. Not gold, not cash, not stocks, not real estate, not bonds. Each has a role. Each has a risk. Each can be abused by emotion. Now consider another popular idea, the fantasy that somewhere inside the American system there exists a clean escape hatch, a place just beyond the reach of central banking influence. People are attracted to stories like that because they want a geography of innocence. They want to believe there is a state, a bank, a charter, a loophole, some forgotten corner of the map where the ordinary rules do not apply. That fantasy tells you something deep about public psychology. People are less interested in understanding the system than in finding a place from which they can imagine themselves safely outside it. That desire is understandable. It is also usually childish. Modern finance is interconnected by design. Payment rails, clearing systems, reserve structures, regulation, taxation, banking practice, and market behavior are all linked. You may dislike the architecture, but you do not improve your position by inventing folklore about being beyond it. Adults do better when they begin by accepting interdependence. The same goes for the Federal Reserve itself. I have disagreed with plenty of macroeconomic thinking over the years, and I have never built my life around worshiping central bankers. But I also know that many people use the Fed as a universal villain because it saves them from the burden of precision. If every problem becomes the Fed, then you do not have to examine debt habits, political incentives, pension promises, fiscal deficits, leverage cycles, demographic pressures, or the choices households make every day. A single villain is emotionally satisfying. Reality is more crowded than that. The truth is that financial systems are not fragile because one institution exists. They are fragile when incentives become distorted, when debt outruns discipline, when people consume tomorrow today, and when asset prices become dependent on conditions too easy to mistake for permanent ones. That is where the real risk lives. You can spend every evening studying rumors about withdrawal limits and global gold rules, and still miss the bigger point, which is that a nation becomes financially unstable when enough people expect assets to rescue them from behavior they refuse to change. No medal can save a person who cannot delay gratification. No conspiracy theory can rescue a household with chronic overspending. No dramatic forecast can outperform decades of disciplined compounding. That is why I often say that the most important part of finance is behavior. People want secrets. The truth is usually a habit. Then we come to silver shortages, mint suspensions, and all the excitement that follows whenever the physical market appears to strain against the paper market. Here again, there is a real subject hidden inside an exaggerated performance. Physical supply matters, fabrication bottlenecks matter, retail demand matters, industrial demand matters, pricing mechanisms matter. The difference between a quoted market and actual deliverable availability can matter a great deal under stress. All of that is real. What is dangerous is how quickly people jump from stress to prophecy. A sovereign mint pauses certain products because prices are volatile or supply is constrained, and instantly 1,000 voices declare that price discovery has broken for good. The paper market is finished. The true value of silver is about to explode, and only the people holding metal in their own possession will survive the coming reset. Maybe, maybe not. The disciplined mind does not leap from signal to certainty. I learned in markets that a strain is not the same thing as a final verdict. A shortage in one form does not always mean the entire pricing structure has permanently failed. A pause in one channel does not by itself rewrite long-term value. Temporary dislocations can matter greatly, but investors get into trouble when they convert every strain into a revelation. That does not mean you ignore these events. It means you interpret them with proportion. If a mint suspension tells you that physical markets can become tight while headline prices still look deceptively calm, then that is useful information. If it reminds you that quoted price and obtainable product are not always identical, that is useful information. If it encourages you to think more carefully about liquidity, premiums, and the difference between theory and execution, that is useful information. But when you cross the line from observation into certainty, you leave investing and enter theater. The theater is popular because it offers emotional payoff. It gives people an ending. And investors love endings because endings relieve them of the discomfort of not knowing. I have never made my fortune by pretending uncertainty was gone. I made it by learning which uncertainties mattered and which ones could be tolerated. That is a very different skill. If you want to know why some people stay financially steady while others are whipsawed by every headline, I will tell you, the steady people are not always smarter. They are simply more loyal to process than to stimulation. They can hear something alarming and delay reaction until they know whether it deserves action. That delay is worth millions over a lifetime. People think wealth is built in moments of brilliance. Most wealth is preserved in moments when a person could have done something stupid, dramatic, and irreversible, but did not. I have lived long enough to watch every generation invent its own reasons for abandoning patience. The stories are always dressed in the language of urgency. This time is different. This rule changes everything. This market cannot be trusted. This institution is compromised. This asset is the only refuge. This shortage proves it. This signal confirms it. This threshold reveals it. This state escaped it. This global rule ended it. When you strip away the costumes, the temptation underneath is ancient. People want certainty without discipline. They want protection without analysis. They want wealth without waiting. And above all, they want an explanation that makes them feel wiser than the crowd while requiring them to do less arithmetic than the crowd. That temptation is poison. If I were building a rational financial life in a noisy world, I would start with plain things. I would keep ample liquidity for real needs, not imagined apocalypse. I would understand what my bank relationships are for, what my brokerage accounts are for, what my retirement accounts are for, and what role, if any, a small allocation to precious metals plays. I would never let my allocation to a fear asset become so large that it silently turned into a speculation. I would know the laws that actually exist, not the ones that are rumored into existence. I would avoid acting on second-hand interpretations when original documents are available. I would keep taxes in mind, but not let tax anxiety dictate my whole life. I would focus on earning, saving, and investing in productive assets over a very long period. And I would remember that freedom in finance usually comes not from finding the one perfect hiding place, but from becoming so solvent, so liquid, so low on unnecessary debt, and so behaviorally steady that ordinary shocks do not force you into desperate moves. That is real power. A lot of people search for power in secret knowledge. I have usually found it in independence. Independence is what happens when you owe little, spend less than you earn, hold assets that can work for you, and maintain enough common sense that fear cannot stampede you. One of the reasons I have never been impressed by financial drama is that drama usually arrives after the math has already spoken. By the time the public is emotionally activated, the underlying habits that created vulnerability have often been in place for years. The family that panics about the banking system but has no emergency fund is vulnerable for a mundane reason. The retiree who is obsessed with gold confiscation rumors but withdraws from long-term compounding every time the market falls is vulnerable for a behavioral reason. The worker who knows every silver market theory but carries revolving credit card debt is vulnerable for a mathematical reason. The investor who distrusts institutions but has never read the actual terms of his own accounts is vulnerable for an educational reason. Those are the real fractures. I am not mocking fear. Fear has a purpose. Fear tells you to look more closely. It tells you something may deserve attention. But fear is a messenger, not a portfolio manager. Once fear starts making allocation decisions, it tends to overconcentrate risk in the very places that merely feel reassuring. That is why I care so much about first principles. When a claim spreads, ask what has actually changed. When a rule is rumored, ask whether it has been enacted. When a product is unavailable, ask whether the cause is local, temporary, structural, or symbolic. When a market strains, ask whether that strain affects price, access, premiums, liquidity, or merely sentiment. When a commentator uses certainty, ask what evidence would make him revise his view. And when you feel emotionally relieved by a narrative, be especially careful. Relief is sometimes a sign that you are being sold a story instead of an understanding. The most expensive sentence in finance is not buy high and sell low. It is, I finally found the one explanation that makes everything fit. Reality is too untidy for that. The financial system can be flawed, over-leveraged, political, intrusive, and occasionally absurd without every rumor being true. Precious metals can have a legitimate role without becoming the answer to every question. Banking institutions can deserve skepticism without making every administrative rule a sign of impending confiscation. Paper markets can distort signals without guaranteeing an imminent and total reset. Maturity means holding those distinctions at the same time. I have often said that investing is simple but not easy. This is one reason why simplicity sounds boring compared with the thrill of hidden mechanisms. But the simple path is still the durable one. Spend less than you earn. Save consistently. Avoid leverage you do not need. Hold cash for needs, not for identity. Own productive assets for growth. Use hedges sparingly and consciously. Understand your legal environment. Ignore most noise. And never let fear make you feel clever. That last point is important. Fear has a way of disguising itself as sophistication. It makes ordinary discipline seem unsophisticated. It makes a person with a steady plan look naive, while the person speaking in dramatic language sounds informed. In my experience, the opposite is often true. The quiet household with reserves, diversified productive assets, a clear understanding of its liabilities, and the ability to sleep at night is usually better positioned than the man shouting about secret thresholds and global monetary resets. The calm person looks boring right up until the moment everyone else needs his kind of stability. I have no desire to persuade anyone that institutions are always benevolent, markets are always efficient, or policymakers are always wise. None of that is true, but I also have no desire to flatter fear by pretending every rumor deserves a life strategy. The job is to think, to read, to verify, to size risks appropriately, to build a life sturdy enough that you do not need dramatic gestures every time the world gets noisy. That is the hidden advantage of discipline. It lowers the number of emergencies in your life, including the imagined ones. When people ask me what separates those who build durable wealth from those who remain anxious, no matter what they own, my answer is almost always the same. The durable people are not trying to win every argument about the future. They are trying to become financially resilient under many different futures. That is a profound difference. If your whole plan depends on one rumor being right, your plan is weak. If your whole emotional world depends on one asset, vindicating your worldview, your plan is weak. If your security depends on withdrawing, buying, hoarding, or reallocating in reaction to every frightening update, your plan is weak. A strong plan does not need constant adrenaline. It can survive uncertainty because it was built with uncertainty in mind. That is how I think about markets. That is how I think about personal finance. And that is how I think about all these recurring stories that sweep through the public. The details matter, of course they do. But the details matter most as a test of your mind. Can you stay rational while fear tries to recruit you? Can you distinguish what is true, what is possible, and what is merely exciting? Can you protect yourself without becoming theatrical? Can you hedge risk without worshiping the hedge? Very few people can do that consistently. The good news is that you do not need to be perfect. You only need to be better than your own impulses. I would rather trust a person who says, "I do not know yet. Let me verify," than a person who says, "I know exactly what this means, and it confirms everything." The first person may grow rich slowly. The second person may remain emotionally entertained forever. One of those outcomes compounds, the other just circulates. At the end of the day, your financial life will not be decided by whether you followed every rumor quickly enough. It will be decided by whether you built habits that could outlast rumors. That means sound earning power, controlled spending, intelligent saving, thoughtful asset ownership, measured skepticism, and the ability to remain steady when other people are desperate to feel certain. That steadiness is not glamorous. It will not trend. It will not make you feel like a prophet. But it will do something better. It will keep you in control of your own behavior and in finance, that is, as close to a superpower as most people will ever get. If I were leaving you with one final thought, it would be this. Do not hand your peace of mind to every dramatic theory about money. Study the system. Yes. Understand the incentives. Yes. Hold some skepticism. Yes. Protect yourself where protection is sensible, but never forget that the biggest financial edge available to ordinary people is still the oldest one. A calm mind, a long horizon, a low need for drama, and the discipline to keep asking before you act, not what is frightening, not what is fashionable, and not what confirms your suspicion, but what is actually true. That question has saved me more money than any forecast ever could.